Welcome to the Deep Dive. Today we're focused on a major global retailer's Q3 results, and the momentum here is all about digital.
It really is.
The headlines are strong. Adjusted EPS hit 62 cents, beating the 60-cent consensus.
Right.
And revenue came in hot at about $179.5 billion, also topping forecasts. They even raised their full-year outlook immediately.
And that's the essential starting point for this deep dive. The company's mission has been, really clear for a while now.
Grow profit faster than sales.
Exactly. And in Q3, they definitely did that, but, and this is a big but, you have to look at the adjusted results to see what's really going on.
And that's where we have to start, because the numbers tell two very different stories depending on where you look. Let's hit that top line first.
Absolutely. So reported total revenue was $179.5 billion. That's a 5.8% jump year over year.
Okay, pretty solid.
Yeah. And if you strip out the currency fluctuations, which gives you a clearer picture, it's a 6.0% gain in constant currency. A really strong sales number.
And here's the confusing part for anyone just skimming the release. The official GAAP operating income actually went down 0.2%. How does that happen when sales are up 6%?
Yeah, that's the head scratcher. It's all because of one very specific non-cash charge.
A single item.
A single item. It's a $722 million charge for share-based compensation at PhonePe.
Their fintech subsidiary in India.
That's the one. It's a charge they had to take because they're gearing up for a potential IPO for PhonePe.
So if you're the CEO, you're telling Wall Street, look, ignore that 0.2% dip. It's a one-time bookkeeping thing. What does the core business look like without it?
It looks fantastic. You take out that PhonePe charge, and the adjusted operating income in constant currency was up a very, very healthy 8.0%.
8%. So they are growing profit faster than sales.
By a wide margin. It shows the core mandate is working.
That really changes the narrative from, a struggle to just stellar execution. And what about gross margin? I mean, with inflation, you'd expect that to get squeezed.
You would. And what's remarkable is that it held up incredibly well. The gross profit rate was basically flat. It was up just 2 basis points to 24.2%.
2 basis points, so almost nothing.
Almost nothing. But the fact that it didn't go down in this environment is, frankly, a huge win for their expense management.
So given that underlying strength, raising the forward guidance makes total sense. What are the new numbers for the rest of the year?
They've signaled a lot of confidence. Consolidated net sales in constant currency are now expected to rise between 4.8% and 5.1%. That's a nice little bump.
And for profitability.
Adjusted operating income growth is now pegged at 4.8% to 5.5%, also in constant currency.
And the all-important bottom line, the full-year adjusted EPS.
That range got a big boost. It's now $2.58 to $2.63.
Wow.
And they're being transparent. That includes a small currency headwind of a cent or two. And to keep this all going, they're planning on capital expenditures of about 3.5% of net sales. So they are not taking their foot off the gas.
Okay, let's unpack how they're pulling this off, because it's clear the whole business model is shifting. It's not just about selling stuff off shelves anymore. It's about high-margin digital services.
That is the pivotal shift. I mean, they're building this whole ecosystem of profit centers that aren't just tied to, low-margin transactions.
And the numbers for that digital engine are they're staggering. Let's start with e-commerce and advertising.
Global e-commerce sales surged an amazing 27% in Q3.
27%.
And what's really critical is that this wasn't just like one hot market. They saw over 20% growth across all their segments. The U.S., international, Sam's Club, all of them.
And that digital traffic is the fuel for the really high margin stuff, like advertising.
Exactly.
So how fast is that ad business growing?
The global advertising business grew 53%. Now, some of that is from the Vizio acquisition.
Right.
But even their homegrown U.S. ad platform, Walmart Connect, grew an incredible 33%. Brands are clearly flocking to them to reach customers.
And membership income just makes that customer base even stickier.
Precisely. Membership and other income was up 9.0% overall, but the global membership fee income was up almost 17%.
That's a big number.
It is. Walmart Plus saw double-digit growth here in the U.S., and internationally, Sam's Club in China was just a standout. It drove a 34% jump in international membership income.
It's amazing. A company famous for selling groceries is now making huge profits selling digital shelf space to other brands.
And that's the entire investment thesis in a nutshell. What's so fascinating is that when you combine that advertising revenue and the membership fees
Yeah.
together, they now account for about one-third of the company's consolidated adjusted operating income.
A whole third. That fundamentally changes their risk profile,
Yeah,
doesn't it?
it's a massive buffer.
Right.
If core retail margins get tight because of inflation or supply chain problems,
Mhm.
they have this huge high-margin cushion protecting the bottom line.
Which brings us right back to why we have to talk about the adjusted numbers.
Exactly. That phone P charge, it's real. It's a stock compensation commitment, but it's non-cash. And it completely masked the fact that these high-margin businesses drove that 8.0% adjusted operating income growth. The phone P charge is just noise. The high-margin revenue is the signal.
Let's transition to the segments then, starting with the U.S. The U.S. consumer story is still the biggest piece of the puzzle. U.S. comp sales were very strong.
They were solid. U.S. comp sales, if you exclude fuel, were up 4.5%. And the quality of that growth was great. It was balanced.
How so?
Well, it was driven by a 1.8% increase in transactions, so more people are coming in, and a 2.7% increase in the average ticket, so they're buying more when they visit.
And the big aha moment for the last few quarters has been the customer mix. Who exactly is shopping there now?
They're seeing broad-based share gains, but the key is that those gains were led by upper-income households.
So the value proposition is attracting more affluent customers.
It is. They're coming in for convenience and deals, especially on groceries, and this retailer is perfectly positioned to capture that shift in behavior.
And for you, the listener, what that means is the company is now competing on a whole new battlefield. It's not just price anymore. It's convenience and digital experience. What categories were the strongest?
Grocery was solid, up low single digits. But the real star was health and wellness, which was up low double digits.
Interesting.
Yeah, that suggests things like prescription delivery are really pulling customers in. And general merchandise was positive too, led by fashion, home, and auto.
Fashion.
Get this, their fashion category grew over 5% every single month of the quarter.
That's a really strong sign. People aren't just buying essentials. And operationally, it seems like speed is the winning strategy for those higher income shoppers.
Speed is the new currency.
Mhm.
They said expedited deliveries, stuff that arrives in 3 hours or less, grew a staggering 70%.
70%.
And those super fast deliveries are now about 35% of all their store-fulfilled orders. They can now reach 95% of U.S. households in under 3 hours.
That's a logistical moat that's hard to compete with. What about inventory? Were they disciplined there?
Incredibly, U.S. inventory was up only 2.6%. That's about half the rate of their sales growth. They're turning inventory over much faster, which is, the definition of efficiency.
Let's shift internationally because the growth there was even more explosive, especially in Asia.
Walmart International was phenomenal. Net sales in constant currency were up 11.4%. That was led by Flipkart in India, China, and Walmex in Mexico.
With Flipkart, you always have to add that asterisk about the big billion days event timing.
You do. BBD definitely helped Q3 sales this year. Management was very clear, though, that this will reverse and create a tough comparison for Q4.
Understood. But just the execution of that event was incredible.
Oh, absolutely. At their peak, their logistics were processing 87 orders per second.
87 a second. That's not just scale. That's a superpower. What about China?
China is just a showcase of digital efficiency. Net sales there jumped almost 22% in constant currency, and nearly 80% of their digital orders arrive in under an hour.
An hour. Wow.
That speed tells you everything about how well their omnichannel model works in dense urban markets.
Okay, finally, let's touch on Sam's Club in the U.S., which just keeps performing.
Sam's Club comp sales were up 3.8%, excluding fuel. And you have to remember, the prior year had a boost from a port strike, so the underlying trend is very healthy.
And digital adoption is key there, right?
It's crucial. E-commerce grew 22%, and their Scan and Go mobile checkout system, adoption for that jumped 450 basis points. It's now used for 36% of sales. That's huge member engagement.
So zooming back out, it feels like all those massive investments they've been making over the past few years are really paying off now.
They absolutely are. You can draw a straight line from their investments to these financial results. The supply chain automation is the engine here.
How so?
Well, for example, over half of their e-commerce fulfillment volume is now automated. That directly lowers the cost to serve, improves the economics, and contributes to that goal of growing profit faster than sales.
And you can see that efficiency right on the cash flow statement?
You can. Year-to-date operating cash flow hit $27.5 billion. That's up $4.5 billion from last year. Free cash flow is up $2.6 billion.
And that kind of cash gives them a ton of flexibility.
A ton. They can keep investing heavily and return capital to shareholders at the same time.
Yeah.
They spent $7 billion on share repurchases so far this year.
That cash position is so critical because it points to the future. So let's talk about where that money is going. They are leaning very aggressively into AI.
It's not just a tool for them anymore. They're treating AI like a core part of their operating system.
For what specifically?
They're focused on sort of three areas:
Mm-hmm.
extreme personalization for shoppers, building out conversational commerce, and this is key, streamlining their own internal processes. They dropped a crazy stat.
Which was?
40% of all their new code is now either AI-generated or AI-assisted. They're literally rewriting how they work.
And they just made a huge external move with a major AI partnership.
They did. The new partnership with OpenAI, which lets customers buy things directly through the ChatGPT interface.
That's a big deal.
It's a massive statement. It says they're going to be present wherever the customer is, riding that conversational commerce wave.
This tech focus even showed up in a big corporate branding move this quarter.
It really did. They announced that they're moving their stock listing from the New York Stock Exchange over to the NASDAQ Q.
And the reason was?
The stated reason was to align their listing with their strategy of being a tech-powered retailer. It's symbolic, but it's important. And it lines up with the big leadership transition, with CEO Doug McMillon handing the reins to John Furner. It feels like the start of a new era.
So what's the big takeaway for our listener here? We've got a really strong Q3. It's driven by high-margin digital growth, smart expense management, and it all leads to them raising their financial targets, even with headwinds like that phone fee charge.
That's the perfect summary. And the crucial takeaway for you is to see this as an inflection point. This retailer is all about value and convenience, and they're backing it up with huge investments in automation and AI.
Right.
The real dynamic to watch now, especially with a new CEO coming in, is this. How quickly can those high-margin revenues, the advertising, the memberships, how quickly can they scale up to completely offset any macro pressures? And can they sustain that core promise of growing profit faster than sales for the long haul?
Yeah.
That revenue mix.
Yeah.
That's the clearest indicator of their future.